Hi everyone, Larry Bailey here with Mortgage Workflow Partners, bringing you another weekly market update. This one happens to be covering what happened last week. That's the week of June 30th, 2025. We had a lot of mixed messages in the labor market data. I'm sure if you haven't seen the news about it, you should dig in. We're going to get into these stories here because there's lots of mixed messages swirling in that labor report. What does all this mean? Here's some of the stories we're going to go through today. We had the first story of strong June jobs report reinforces Fed's caution. The next story is private payrolls decline in June. The next story is May job openings rise unexpectedly. We follow that up with a story about continuing unemployment claims edging closer to 2 million. We've got a family hack of the week for you to check out, and then we'll talk about what to look for this week. So this first story in here, we're going to get into the strong June jobs report reinforcing the Fed's caution about cutting interest rate. And so we see this graph on here brought to you from the BLS, Bureau of Labor Statistics. And if you're not seeing this, it's because you're listening on podcasts, which I truly thank you for. But you should head over to masteringencompass.com. Not only check out this whole video, but then also check out everything that has to do with mastering the Encompass platform, from workflow suggestions to best practice settings reviews to an AI coach to help you with everything that you could imagine. And of course, we get in our weekly meetings if you're taking the admin course. So check all that stuff out. So here's the story. We've got June jobs report from the Bureau of Labor Statistics. That's a BLS. That came in stronger than expected, showing 147,000 jobs added last month, which was well above the 110,000 forecasted. Positive revisions also added another 16,000 jobs to the April and May totals combined, which is a notable change from recent downward adjustments. Looking closer at the numbers, there is a significant portion of the gains came from government employment. Matter of fact, 73,000 to be specific, with state and local education accounting for 63,000 of those jobs. So let me re-say that. Out of the 147,000 jobs reported as gaining, 63,000 of those, so a huge percentage, came from hiring at the state and local education spots. Interesting. The unemployment rate also saw a slight dip, falling from 4.2% to 4.1%. So the bottom line, of course, is that the Federal Reserve keeps a close eye and watches both the inflation numbers and the employment data because they've got this dual mandate, right? They've got to keep prices stable. They've got to achieve maximum employment. Of course, this is very tricky, especially with the economic uncertainties like new tariffs in the mix. Generally, if inflation remains high, the Fed is less likely to lower interest rates. Conversely, if the signs showing a slowing economy, that might lead them to consider cuts. Given the current economic picture, policymakers have been sticking to a cautious, quote, wait and see approach, and they've kept their benchmark interest rates, known as the Fed funds rate, steady at 4.25% to 4.5% throughout this whole year. So quick note here, important to let you remember that this benchmark Fed funds rate, it is the overnight lending rate between banks, which then impacts broader interest rates across the economy, like credit cards and such, but it does not directly impact the long-term interest rates like mortgages. The Fed's future decisions will continue to depend on, of course, incoming data. They always want data. So they've also pointed to a solid job market as a key reason for their current cautious stance. While we're starting to see some signs of cooling in the labor market, more on that in the coming stories, the stronger than expected June report reinforces the likelihood that the Fed will remain cautious approach and keeps the rate steady at their meeting later this month in July. We'll see. We'll see what happens. All right, next story. Private payrolls decline in June. We see that the private sector shedded 33,000 jobs in June, significantly missing the expectations of a gain of 95,000. So we were expecting to gain 95,000. ADP reported they lost 33,000. And of course, this is in direct contrast to the BLS report that we just heard about a minute ago. This marks the first decline since March 2023 and suggests economic uncertainty is impacting hiring. May's already tepid growth was also revised lower from 37,000 to 29,000 previous report. Small businesses, that's the 149 employees like me, were hardest hit, cutting 47,000. We actually didn't cut in last month. We actually hired last month. Medium firms for 50, which is 50 to 499 employees, also lost lost 15,000 positions, while large companies 500 or more employees added 30,000 jobs. By industry, the leisure and hospitality led the gains with 32,000 new hires, despite signs of slowing travel and tourism. Professional/business services, they lost 56,000, and education/health services lost 52,000, reported the largest losses. So there's there. Wage growth eased slightly to 4.4%, while existing employees and 6.8% for job stayers. So these numbers are fairly in line with what we've seen recently. Bottom line here is Dr. Neela Richardson, who is ADP's chief economist, noted that while layoffs are still rare, quote, a hesitancy to hire and a reluctance to replace departing workers led to job losses last month, close quote. However, she added, quote, the slowdown in hiring has yet to disrupt pay growth, close quote. All right, next story here. We've got May job openings rising unexpectedly. May saw a surprising increase in job openings, rising to 7.769 million from April's 7.395 million and exceeding forecasts. The strongest growth occurred in the leisure hospitality, finance, insurance, and healthcare sectors. However, other labor market indicators show less strength. Both the hiring rate, 3.4%, and the quit rate, 2.1%, remain near their lowest levels in a decade, excluding the pandemic, of course. It's important to note that these persistently low rates suggest that job seekers may face challenges and worker confidence in the labor market could be subdued. Bottom line here is, despite the increase in May, the total number of openings is still significantly below the peak of over 1.2 million seen in 2022. Furthermore, the reported figures might be inflated by remote job listings posted in multiple states, potentially overstating the number of unique opportunities available. Plus, a significant indicator of cooling is the job openings to unemployment ratio, which has fallen sharply from over 2 to 1 in 2022 to roughly 1 to 1 today. Yeah, that number, we did see that number drop, and if you've been following me over the last couple of years doing these weekly updates, yeah, we saw that fall. Obviously, we don't want to see less than 1 to 1. That would really not be good. What that basically means is we've got more people to job openings. 2 to 1 means we have openings. We have 2 openings for every 1 person, so it's easier for people to change, and there's recruiting that can happen. But when it's 1 to 1 or less than 1 to 1, it becomes much, much harder, and people stay unemployed longer, which leads me into the next story. Continuing unemployment claims edge closer to 2 million. It's a huge number here, gang. Initial jobless claims dipped slightly last week, falling by 4,000 to 233,000. While a small drop, this number is still higher than what we saw earlier this year. What's more notable is the trend for continuing claims, of course. People receiving benefits for more than a week is what's considered to be continuing claims. This held steady at a high of 1.964 million. Continuing claims have been stubbornly above 1.8 million for over a year and now consistently above 1.9 million for 6 straight weeks. Bottom line in the story is a combination of elevated initial claims and persistently high continuing claims signals ongoing pressure in the labor market. This is where the Fed's paying attention. Crucially, since unemployment benefits only last 26 weeks, they were extended to 52 under the pandemic, but they've been, I don't think anybody's more than 26 weeks right now, but correct me if I'm wrong. This is the fact that continuing claims remain high even as people benefits expire, points to an underlying weakness and a slower pace of hiring than needed to absorb all of those looking for work. Family Hack of the Week. July 11th is National Blueberry Muffin Day. I had some blueberries. My birds ate the damn things. Raspberries too. They ate them all. I don't know what happened. Anyway, if you have blueberries, maybe go buy them from the store if you don't grow your own. Here's a recipe from the Food Network. Yields 20 muffins. If you're listening on podcasts, head over to masteringencompass.com to this spot in the video, replay, and check out the recipe. Make them and eat them. There's nothing better than blueberry muffins, especially if you put some granular sugar on top and you melt it and it's crunchy. It's good. I don't know if that's in this recipe, but try it. It's good. Here's what we're looking for this week, gang. We've got a relatively quiet week, of course, not expecting any big news stories. Key highlights include the release of Fed's latest meetings on Wednesday and weekly unemployment claims on Thursday. Investors will also be closely watching the Treasury auctions. That's the 10-year note on Wednesday and a 30-year bond on Thursday, and we're going to look for insights around the market demand of bonds, especially long-term debt, to see exactly how high the yield is going, because that's what the bond traders are really looking for. They do not want to get shortchanged in the long run. If they feel that things are going to get more expensive in the future, they're going to demand a higher rate. And if they're demanding a higher rate, again, that's all the more reason for the Federal Reserve to not lower short-term lending. So there you go. My name is Larry Bailey, Mortgage Workflow Partners. Check us out over at mortgageworkflowpartners.com. Or if you want to learn more about Encompass, just go to masterencompass.com. Guarantee you'll learn something. See you there. Bye-bye.